Hello, traders. It is 8:01 a.m. Chicago time on Thursday, the 17th of May, 2018. Thanks for joining me. Got the wrong slide up. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Overall, we're looking at a market that is relatively unchanged. And it looks like the dollar's holding pretty well. The leader today is crude oil. Crude is showing a gain of 54 cents, currently at plus 0.73%. The laggards today. Sorry, there's a lot going on here. The laggards today, the Nasdaq's down $30.50. Cisco reported it beat, but the call did not give good forecasts, and the market's responding to that network equipment giant. So overall, the S&P currently is trading at 2718.75. It is trading inside of yesterday's value, inside of the range, and it's holding higher. So let's go over yesterday's action. As far as what could impact us this morning, not seeing anything on the calendar. We did have fully Fed come out about a half hour ago, and we're waiting for U.S. leading index, which could be a move. We're expecting 0.4% for April. That comes out at 10 a.m. A bunch of Fed speakers today. So pay attention to the calendar a little bit. Here's what we expected yesterday versus what we got. Yesterday was definitely way off, and I'll explain why. All right. So yesterday, the expectation is we would open at 2706.75 below the point of control, and right in the middle of value. Given yesterday's stance, or the prior day's stance, Tuesdays, the expectation was for continuation lower. So the primary scenario was for a test higher into the point of control, then roll over and push out of range down into 2690.75. The secondary, an immediate push down into the low, consolidate, then come back up, and then retest the point of control and hold steady inside of Tuesday's range. The tertiary, the third scenario, is a quick open test drive down and looking for a push into 2690.75, but looking for more of a trend type move. Here's what happened. Almost the exact opposite. Completely the opposite. The market ended up rallying right before the cash open. And it basically changed. It changed the nature of what was happening, given the overnight profile and what we'd done overnight. The first three scenarios were looking for continuation lower on the gap from Tuesday, and what yesterday did is it rallied right before the open. I'll show you that in a minute, and it was unable to hold on to the value of the prior day. So we couldn't even touch the point of control from the top. We opened right at value high. We pushed right out of the range to 2719.50, pulled back to 12, and then took off to 27 for an impulse move. There's the impulse, boom, right there. And then we have a pullback, and then we have a continuation move, and then we started to work on a correction potentially. Before the market ended up dying, or not dying, closing. And so this scenario is really a scenario 5 for me. 4 was test down, test value low, push into the point of control, push through the point of control, consolidate near highs, test the gap to the mid, which was 2720, and then come back into the prior day's range. Scenario 5 was just this, open. I did have it testing lower to value low, and then pushing out and closing the gap up above all the way up to 2729. And of course didn't quite get there. It came up 4 ticks short. So I don't usually go through those 3, 4, 5. But again, yesterday's rally right before the close kind of blew things up a little bit. Let's get rid of these. So here's yesterday. Well, this is what we looked at. Let's get rid of this. Here's yesterday. We had a sideways. Yesterday's Globex, we had a sideways, and then right before the open, we had this strong push up, this rally up, and then we continued it during the day session. Since then, since yesterday's close, we went sideways on the Asian session, completely sideways, very low volume, relatively low volume, and then it started to drop off on the European Open and consolidate at the lower end of the range. So if we stretch this profile, so let's stretch this profile a little bit, make it look like it was a decent trade, we'll see a double distribution. There's one distribution, there's the second distribution with a low volume node right in the 2721 area. And we're currently trading 2720. We just popped up to 2720. We're underneath this 2721. It is anyone's guess what the open is going to look like. We do know that we are inside of the prior day's range and value currently where we stand. So we've tested below yesterday's value low, and we are back into the value area. And overall, volume, as I said, volume is low, and the inventory is short, slightly short this morning. The delta is a little bit higher, slightly positive, despite the short inventory. So this morning, sit on your hands, wait for the market to decide which side is likely to win the battle. Looking at what we've got going forward, the expectation is we would open right here. 20 minutes left to the open, could push either way, but it looks like it has tested down below the lower distribution. You could see that the low of the overnight session, this blue line, that's the overnight low, 27.15.50. It was just pushed down from 27.16, is right on top of the lower distribution of yesterday. So that was formed back here. Okay, then we popped up yesterday and consolidated to form an additional upper distribution. And we tested that lower distribution, and we are moving towards the upper distribution. In fact, the upper distributions, let's do this. The upper distribution starts really, the key low volume node is really right there, right on top of that 2721 area from the overnight as well. So that's what we have coming into today. Knowing that, the primary expectation is, again, we've tested down below. We've tested into 2700. We found buyers. So that's the narrative. The narrative is 2741. We gapped down. We sold off. We extended to 2700 even. We stopped at 2750. Push up to 2720, which is a key high volume node. Pull back to 2712. Continue into 2728, and now likely to continue higher Okay, the gap was closed. This gap was closed yesterday. Okay, so there's a fair amount of buying pressure coming into yesterday afternoon, and it's likely to carry forward today. This morning, expecting an open auction that pushes right into yesterday's point of control, and the overnight high is expected to be taken out, and I'm looking for it to test the 27.28 at some point. 27.20 is a magnet. We're likely to consolidate here quite a bit, but I'm looking for a push into that 27.32.75 at some point today if yesterday's trend or buyers continue to be active. Okay. Again, the dollar's strong. Gold is weakening. Overall, there's some macro movement. You got to keep an eye on treasuries and yields and all that good stuff. But that's the nature of the trade that we're in. We're essentially creating a new channel based on yesterday's action. Secondary, open, tests higher, unable to find buyers to continue, starts to move lower into the lower distribution. The overnight low gets taken out. We bounce at the stock zone at the low, 27.12, and then we break into Tuesday's range and pop back up. It's not likely to push through the 2700, although I'd love for it to do so, just to give us a little bit of volatility and clarity as the volatility comes in. So the secondary is looking for a break of yesterday's low and a potential test into Tuesday's range, all the way down potentially to 2704 and a quarter. It's not likely to get into 2700 today. So I'll leave you with those. I just want to say something about the trade, though. The trade right now is, I have to admit, it is because of the lower volatility, the lower volume. If you look at the volumes here, something you want to note, the lowest number in each one of these boxes is the volume, the pit session volume. Okay, so yesterday, 872,000. The day before that, which was a gap and go, was 1.27 million, which is pretty good volume. The day before that was 790,000 right here. Day before that, 882,000. Day before that, almost a million, 998,000. So the most common daily volume for the pit session for the S&P is 1 to 1.1 million. And days like yesterday had, every time we pop up, see this quick pop up, we have very little participation. And those days are difficult to read. We get conflicting signals. The delta is conflicting with the price action. A perfect example of that is right here. A nice push up the open, not much delta, and any retests as the market tests back to the open, where delta should be zero, right here, delta is negative, and it continues to slide down, negative, even though the market started out higher. I find these days difficult to read. Does that mean I should, go play Fortnite for a couple of hours while the market sets up or whatever? Maybe, but what it's telling me is there's a change coming. There's some discord, and it's been this way for about a week and a half. The market almost is creating this disjointed type of trade. We get a lot of multiple distribution profiles. We have a lot of disagreement on value. So we see multiple distribution profiles, very common now. And so this is another thing that indicates that the market's not able to find consensus and find value. It's not acting in an orderly way. So with that being said, this is the kind of market that is likely to take a week or two or a month or two's worth of progress, and then blow them up in a day or two. You're going to see that happen in this environment, because what you're doing is you're trading off of what made money, and you're trying to push it. As soon as you start to make money, you build up 1, 2, 3, 4, 5 a week, 2 weeks, a few days or 2 weeks, and then you start to increase your size because you want to make some real money, and you're not responding. You're not catching the fact that the market is changing. It's slowing down. Like volatility is just diminishing very quickly. And so you start pushing those breakout trades, or you start pushing continuations after impulses and so on. But the market's really trading in a regressive mode, a return to the middle type of trade. I call that outside in, and so on. And then before you know it, you're fighting. You consider the money you've made almost like house money, a credit for you to take more risk, and therefore you trade bigger size, less risk. You're disobeying your risk plan because you made some money, and you think you can afford it. You think you can't really afford it. You think you can afford to expand your risk limits, and then blow up, right? Then you're just destroyed what you've made over the last couple months. You have to continuously recognize that, that's kind of odd. Let me stand back. I have not traded a full unit in about 2 weeks. I've not traded a full unit. I'm breaking up my units to 1/6 or 1/8 and look to scale in to test the market to see where it's going. And I end up often getting filled on just a partial unit and managing that, which doesn't give me the longevity in the trade. I run out of bullets, basically. I run out of contracts to scale out of. So my point is, stay current with the market. Pay attention to what it is that you're looking at. It's really important in this kind of environment to reduce the number of variables you're looking at to as few as possible. So if you're looking at the market in terms of I'm looking at volume profile, that I'm looking at fibs. In addition to volume of profile and fibs, I'm looking for day type levels, prior highs, prior lows for support resistance, traditional support resistance, or I'm looking at this and that. And I'm looking at internals, and I'm looking at underlying sectors, and I'm looking at I'm looking at correlations with the 10-year yield. I'm looking at the correlation with the NQ and the Russell and the EMD. That's going to drive you nuts in an environment where it's just not doing much. It's testing, moving away, establishing new short-term acceptance. That's the double distribution. So we form a distribution, move, create another distribution, and then move again. You look at these peaks from Tuesday. These are pretty deadly here. These peaks. You'd have to be pretty good at determining that sellers are in charge. You see that in the delta right here. Sellers below the zero line all day long, to sell these spikes. These things looked like, oh my God, this is a reversal. The bottom is in, and then it just drops off. Frankly, it's hard to predict that that's what's going to happen, and it's hard not to lose or take a stop out or 2 or 3 or a stop limit that day. And just understand that each trade is unique. Each setup is unique. You cannot correlate the last trade or the last setup to the current trade. It is absolutely unique. So I'm not telling you to pick and choose which trades to take. I'm telling you to pick and choose, to reduce what you're doing to something that is very easy to act on, or very quick to act on. And so you're not picking and choosing which trade. If my plan is to wait for the breakout of the IB, and then my trade is to trade a pullback for a long against this yellow line, this IB mid VWAP in the same spot. Hey, that's a golden setup in a stock zone. I'm going to take that. I'm going to take that trade every day, because I don't know which one is going to work. However, yesterday, if you had taken this with a tight stop, you would have gotten stopped out, because the market poked below the mid, below the IB, below the stock zone, and it would have stopped you out. probably by a couple ticks. You still have to take that trade. If that's your setup, you have to take that trade. And you have to get stopped. Even though you might sense that, hey, I'm likely to get stopped, you still have to take that trade. And of course, this is the closing bar. So it's going to act a little bit irrationally. But you get my point. And in order to take that trade, those are my parameters. Stock zone, mid, VWAP, IB, confluence, trade. Done. Right? I don't care what the internals are doing at that point. I don't care what the underlying tech sector or financials or whatever. I watch those things for context. I talk about them for bigger picture context. What is the market trending towards? What does a tick look like today? What does S&P breadth look like today? To give me an idea, but I can't trade off of those. It's too much input. In addition to that, I'm layering order flow on top of that, right? I'm layering this on top of that. It's too much information. So I create the setup with this. I say to myself, this is the area I'm looking to trade. Okay, that's my setup. And then I go to my order flow and I look at the order flow and how it's operating. How are things printing? I can see the prints. I can see, look at this. So much more printing on the offer. Nothing on the bid. The green line's the bid. The red line's the offer. The green dots are actual trades. The red dots are actual trades on the bid. So then I go to order flow. But if you try to pack all this in all at once, you're in for some trouble. Anyway, I went way over my time, but I want to remind you that there are times like this. And you just need to chill out and reduce, distill down, get rid of the trimmings and just get down to the meat of the meal. Good luck.